You put $10,000 into your favorite trading platform and decide to trade one mini lot. You wake up in the morning with a 50 pip profit. That's $50. Amazing, right? That's until you open your trading account and you see that your actual profit is less. In this video, we're going to calculate how much of that $50 you actually get to keep. And we're going to do this by explaining the 4 fees that brokers charge when you trade Forex. This includes one hidden fee on your profits that's hidden in the fine print and only industry experts really understand, and another fee that you should never ever want to pay. First, we have spreads. Spreads are the difference between the buy and the sell price when you trade currencies. For example, if you trade Euro USD and the price is 1.1000 slash 1.1002, then the spread is 2 pips. And this 2 pips will cost you $2 when you enter into the trade. Spreads are variable, they're not typically fixed. And the broker won't actually tell you how much they're going to be charging you in the spread. It's a very non-transparent way of charging a fee. And spreads can vary widely. For example, if there is market news or highly volatile conditions, then a market maker might widen the spread by 10 or 20 times. And you may not even realize this unless you're planning carefully for it. But perhaps less understood, and just as importantly, the wider your spread, the further away your profit target is and the closer your stop loss is. So if you've ever been in a trade and you've just been stopped out, that might be because you've had a wide spread. And not only does this cost you the spread, but it might cost you the $50 profit that you were going to make on the trade as well. This is why I recommend you never trade on an account with a spread markup. It's always worse off because over time you're going to have more losing trades just because the spread is wider compared to an account that doesn't have a marked up spread. Now thankfully there's easy ways to trade without having a marked up spread, and we'll talk about these later in this video. The industry average spread for most currency pairs, according to Forex.com, is 1.625. So that $50 goes down to $48.37. This may not sound like a lot, but there's more fees to come. Next up we have commissions. This is a simple fixed fee that brokers charge on every trade you place. Now some brokers will advertise 0 commissions, but what this means is they're marking up the spread instead. Commissions can have a big impact on the profitability of the account over time. Let's say you pay $3.44 per round trip. If you make 5 trades a day and trade 5 days a week, that's $17.20 per day, or $372 a month, or $4,472 a year just in commissions. There are some ways you can save on commissions. If you're an active trader or a scalper, you can work with a broker that has an active trading plan. So this is an account where the broker will charge you lower commissions if you trade a higher volume. You could also negotiate with your broker about how much they're going to charge you in commissions. The larger your volume, typically the lower commissions you'll be expected to pay. You could also check out a broker that offers subscription-based trading. This broker won't charge you a commission per trade, but will instead charge you one flat fee for all your trades in a month. The industry average commission for the most popular currency pairs, according to Forex.com, is $3.44. Since you traded a mini lot, it's 10% of that number. So your $50 is now $48.03. The third one is overnight financing, also known as swap fees. This is a fee that you are charged when you hold a trade overnight. This fee is based on the interest rate differential between the 2 currencies that you're trading. Even when the interest works in your favor, brokers still take a cut. They add a markup to the overnight financing rate. For instance, holding Euro USD overnight might cost you 0.39 pips, and this would equate to 39 cents if you're trading one mini lot. There are some ways to minimize swap fees. The first of these is to day trade or avoid holding the trade overnight. You can look for a subscription-based broker that does not add any markup to the overnight financing fee, or you can look for what are called carry trades. This is where instead of paying the fee overnight, you actually earn the fee because the interest rate differentials are in your favor. The average swap for the most popular currency pairs on the most popular platforms is around 0.39 pips, according to my FX book. If you hold your mini lot for one night, this will cost you 39 cents. So your $50 is now $47.64. And the fourth one is admin and currency conversion fees on profitable trades. One trick brokers do is they will charge you what they call a currency conversion or admin fee of 0.5 to 1.5% on your profitable trades. The important thing here is this actually costs them nothing. So it's purely profit going from your account to the broker. Imagine if your broker said they would charge you a percentage of your profits. Would you open an account with them? If you're like me, you'd run for the hills. Well, this is exactly what is happening. And it's not the small brokers, the big listed brokers are the culprits. I know because I was there when the broker I worked for decided to add this fee because all the competitors were doing it. Sometimes they label this fee as currency conversion, sometimes they call it an admin fee. The important thing is that it's hidden in the fine print. It's very difficult for even someone experienced to find how much this fee is actually going to be costing the trader. This fee is charged on every profitable trade. So when you have a profitable trade that's not in the base currency of your account, those profits need to be converted back to the base currency. And it's here that the brokers add their markup. So how do you avoid this fee? It's difficult. So I would ask the broker directly, what is your fee on currency conversion through their chat? You can also look in the fine print, but trust me, it's very difficult to find what this fee is a lot of the time. You can also consider subscription-based platforms to avoid fees per trade. So if we take away this 1.5% fee, your final profit is $44.68. So each trade costs you $5, which in this case is around 10% of the profits you've made on the trade. And if you trade multiple times in a day or week, this could end up costing you hundreds or thousands of dollars in lost profits. If you find this all very complicated and complex, you're not alone. The way this industry prices its fees is not very transparent at all, but it does not have to be that way. Trading is hard enough without all these fees eating away at your returns. And that's why we created a fairer and more transparent way to trade. At MarketMates, you can trade on real market prices with no added fees. This means no markup to the spread, no markup to the swap, no markup to commissions, and of course, no hidden fee on your profits. You simply pay one flat monthly fee of $49 to trade up to 200 lots a month. And then your only costs are the costs we get from the interbank market. If you make more than a few trades a month, well, you do the math. If you're a smaller trader, we even have a free plan, so you can get started without paying any added fees whatsoever. And it's not just Forex. Maybe you like trading gold or Bitcoin instead. We have some of the lowest costs and fees on Bitcoin in the marketplace. So if you're sick of all these numerous complex fees when you're trading Forex, crypto or other markets, click on the link below to learn more. I'll see you in the next one.